You got to be flipping my flapjacks. We have drama, folks. Starbucks came out after the bell and just announced a complete disaster. I mean, a complete disaster in what's going on with their business. We got to run through that. 5 minutes later, literally 5 minutes later, McDonald's stock completely crashes as they have an E. coli outbreak. Then 5 minutes later, Enphase Energy stock crashes. Oh boy, we're going to react to all that. I'm going to tell you what's going on in regards to those situations. Are any of those stocks buy the dip opportunities, or are they not? Okay. Then we're going to react to a few videos here. First one up here, the Fed will have 225 basis point cuts over the next 2 meetings. Looking forward to react to that one. Meta's revenue has room to run despite the AI spending, says Jeffries Brent Thill. So looking forward to reacting to that one. And then Mr. used to be a big old bear, Mike Wilson of Morgan Stanley, on his opinions on earnings, tech, and a bunch of other subjects. Appreciate y'all joining me as always. Thanks so much for being here. Thank you for smashing that like button. Thank you for being subscribed to the channel. This is a holy smokers. This ain't no dang jokers, folks. 2 nights ago on the main channel, I let you guys know, like, you know, it's like being in the ocean, right? You're going up, you're going down, and then all of a sudden, that big wave comes, smacks you, and that's all of a sudden what happened after hours here. What absolute craziness, okay? So, Starbucks shares slide after coffee chain says sales fell again, suspends outlook. What? What is going on here in regards to Starbucks? For the third consecutive quarter, Starbucks same stores fell. This quarter's 7% decline in same store sales was the company's steepest drop since Rona. Oh my gosh, this Bucky's a mess. I am so happy I stayed away from this one. The company blamed its soft sales on weaker demand in North America, its home market. Its same-store sales decreased 6%. Traffic tumbled 10%. Traffic was down 10%. What? Despite increased investments in the business, like more frequent promotions and its mobile app and expanded range of product offerings. Yeah, I mean, I can tell you that last quarter, they were promoting like crazy. They were doing like buy one, get one free and all types of crazy stuff. I've never seen Starbucks promote like that, like trying to get any way. Like, I've never seen that before from Starbucks. Crazy. In China, its second largest market, same-store sales plummeted 14%. 14%? These are like crazy numbers. The company attributed the decline to competition in the country, which said it's altering consumer behavior and changing the company's strategy for the market. Oh my gosh. The company also suspended its fiscal 2025 outlook, citing the recent CEO transition and the current state of the business. Despite the dismal quarter, the company increased its dividend. You gotta love that. Despite their business being a complete dumpster fire, and same-store sales being down 7% and down 14% in China, despite it being a complete dumpster fire, they increased their dividend from 57 cents to 61 cents. You gotta love it, right? Quote, "We want to amplify our confidence in the business and provide some certainty as we drive our turnaround," says the CFO of the company. They also added that the company is developing a plan to turn around the business, but creating a strategy will take time. Okay, so Starbucks, is this even, is it worth touching this stock? You guys know I love falling knives. Let me put that crystal clear. If you watch me for any amount of time, you know I love buying great businesses, great companies that are falling knives and they're on tough times, right? So would that fit the criteria of Starbucks? Let's think about Starbucks over time. It has been a great business over the past 30 years. There's no debating that. The profits are immense. It's a worldwide, global known brand. It's known all over the globe, right? And it has a pretty simple business model that at the end of the day, they produce incredible profits from that company, right? But with all that being said, and the stock crash and all this stuff, right? Mr. Chipotle coming at the company, is this stock, am I looking at this as a potential buy on this news? It's a don't touch. It is a don't touch. And you know how I love falling knives, but this one's a don't touch. It's too messy. It's too messy, and I cannot see a clear path of turnaround here in terms of their sales going any major way positive. There's no way of there's no magic button to hit here that's going to turn this one around, in my opinion. It's not like they can come out with some new innovative product or service tomorrow and it's going to like change the game, and everybody's like, oh my gosh, can you believe they did that? The only thing I could think that could be a game changer for Starbucks, but it'd be an insanely big investment for the company to make, is if they wanted to go fresh food and actually start making food in the Starbucks locations and doing that on a high level. But is that realistic? Does Brian Nickel, Mr. Chipotle, is he going to take them there? Probably not. He's probably not going to take them there. That's the only thing I could think that could maybe be a game changer for Starbucks if they actually got known as like having good quality food. But that's probably not happening. So there's no magic turnaround here. They could say, okay, well, let's just go up a bunch on prices more. Okay, you can do that, but then you'll turn off even more customers. They're in a messy situation. And so when you're in a messy situation and they got a big debt-ridden balance sheet as well, it's not interesting to me. There's a lot better opportunities out there. There's a lot better opportunities out there than Starbucks to make money over the next few years. Not saying you can't make any money in the stock. I'm just saying, like, if you were to tell me I'd either be in Starbucks or be in a treasury, I'd take the treasury over Starbucks, right? Never mind how many stocks have such big upside over the next few years ahead. Starbucks is just not one of those. McDonald's shares crash after the CDC says E. coli outbreak linked to quarter pounders? What? McDonald's shares fell in extended trading. CDC said an E. coli outbreak was linked to the chain's quarter pounder burger, which is very popular. My guess is it's probably the second most popular burger at McDonald's, only behind the Big Mac. The outbreak has led to 10 hospitalizations and 1 death, the CDC said. The restaurant chain said initial findings from the investigation show some illnesses may be linked to onions that were used in the quarter pounder. Okay. So here's a little kind of illustration of where the issues have been so far: Utah, Colorado, and a few other states, if you want to check that out there. Quarter pounder hamburger will temporarily be unavailable at several western states, including Colorado, Kansas, Utah, Wyoming, and portions of other states, McDonald's said. It added that it's working with suppliers to replenish ingredients. Obviously, this is likely going to go viral all over the internet, right? Given that it's E. coli linked with McDonald's. My thought is it's going to be everywhere on TikTok and Instagram and Facebook and X over the next 48 hours. And so that is problematic for McDonald's, right? I mean, it's one thing that you say, okay, they might miss some sales at quarter pounders in some of these states for the next bit of time. That's not good. But just being linked to an E. coli situation like this is not good. That can definitely turn off some folks. Like, there's always a lot of misinformation in regards to these situations, a lot of like confusion. At the end of the day, just the people are going to associate like McDonald's and they got an E. coli situation go on. So a lot of people are, a decent amount of people are probably going to go out of their way to avoid McDonald's in the short term. That does not mean they're going to avoid McDonald's for the next 5-10 years, but will they avoid McDonald's for the next few weeks, the next few months? I think there's a decent probability that's a good chunk of people will do that, right? Which is not going to be great for same-store sales in the short term, right? So that is a problematic thing. Now, am I interested in McDonald's stock? Here's the thing. I'm not. It's another don't touch for me. I don't care that it's down to 293. I don't care if it's down to 280 tomorrow. It means nothing to me. There's much better dividends. And let's be honest, if you're playing a stock like McDonald's, you're playing it for the dividend, right? You want that dividend yield. You're expecting that company to go up every single year on their dividend, and then you can get some capital appreciation along with the shares, right? My opinion is there's much better dividend stocks out there. I did a video just an hour ago. I released it on the main channel. Top 7 dividend stocks to buy. Check that video out. It's on my main channel, Financial Education. Not sure if you guys watch the main channel or not, but that one goes all into 7 dividend stocks that I love that have, in my opinion, much better capital appreciation stories going for themselves over the next several years and better dividend stories going over the next several years than McDonald's, okay? So next one up here, Enphase Energy. This stock is crashing after hours, down about 9% there. And this puts Enphase Energy all the way back to a similar stock price it had in the summer of 2020. 2020, folks. Over 4 years ago. So Enphase is in a bad place here. Here's the deal. The company missed on EPS. Adjusted EPS, 65 cents. They missed the 77-cent estimate. Sales of $380 million. 391 was expected. That's another double miss for the company. I believe they also missed, I think they missed last quarter as well, if I recall. I pay attention to so many companies' earnings. Sometimes it's hard to remember them all, but I believe they missed the previous quarter. The moral of the story is Enphase is not doing well at all in regards to their business model, and they're missing numbers, and it's embarrassing, right? If you look at their income statement here, it's a dumpster fire. Net revenues, $380 million from $551. Gross profit was down to $178 million from $262. They brought down R&D, sales and marketing, general administrative expenses, but not to a super large number to really offset this massive decline in revenue. Income from operations fell to $49 million from $117 million. Interest income was, slightly, very slightly up. It's almost flattish, right? Meanwhile, as far as interest expense, that was up significantly for the company year over year. Net income came in at $45 million versus $113 million. That's way over a 50% decline there. Diluted EPS 33 cents versus 80 cents. That's what, like a 60%-ish ballpark decline there. Complete dumpster fire for Enphase here. Is this D- income statement for Enphase, right? And in regards to Enphase, here's the deal. If you look at the 30-year mortgage, it's actually started to go up again in terms of rates. It was a big hope and thought process of, Fed's going to cut rates, mortgage rates are going to go down, everybody's going to go buy a new house, and that's going to be great for Enphase because Enphase could be in a situation where, when people buy a new home, people view it as there's a higher probability they might also get solar. Then if you could talk about interest rates being lower in general, right? Then people that take out debt to buy solar, which is a lot of people, that might be good for solar. Well, we're just not seeing any of those benefits in any way at all, right? And there's also fear about the election. If there's another big fear in regards to an Enphase here, and it's election related, right? And the election is only 2 weeks away. It's only 2 weeks away now. There's a big fear of what? Red wave. And that could be seen as a great thing for a lot of stocks in the market, but not a lot of these energy-related plays in terms of renewable energy, right? And so if there's a red wave, a lot of people are going to look at, these type of solar companies as kind of not at all the play, given if that does happen, right? So we'll see, how the election goes, obviously, but the moral of the story is these numbers are really bad at Enphase. And keep in mind, this quarter last year was not even a good quarter for Enphase. So their business was already starting to struggle back then. And so it's just getting a lot worse in regards to them. So does Enphase stock interest me to buy? No, it still doesn't. No, it doesn't. There's too many other opportunities to look out there, and I can see exactly how they can change their business model without being, because basically Enphase is kind of like the victim of interest rates, and they might end up being a victim of the election, depending upon which way that goes, right? And so I look at that and I'm like I don't want a company that I feel like things out of their control is what's going to have to happen for the story to turn around. I want companies that they can control their own narrative, their own products and services, and the demand levels for those products and services, right? So, yeah, Enphase doesn't interest me, okay? All right, let's react to some videos here. By the way, pin comment down there today if you want access to all my premium course library, Become a Master Stock Market, Millionaire Playbook, Stock Options Mastery, Dividend Investing Mastery, also access to see the stocks I'm buying and selling in my $2.4 million Fidelity account, exclusive weekly videos from me, and access to our premium investing platform, which is 1000xstocks.com. If you want access to all that, pin comment down there. You can click on that, fill out a form. We'll see if we can get you access to all that maybe this later on this week or next week. The Fed will have 2 25 basis point cuts over the next meetings.
The first time in some 3 months. So what does all that mean for the Fed's November meeting? Now just 2 weeks away. Joining me now to discuss is Richard Clarity. He's the former Federal Reserve Vice Chairman, PIMCO's Global Economic Advisor. Welcome back. It's nice to see you.
Likewise.
Are you surprised by how much rates have backed up since the jumbo cut?
The jumbo cut.
Well, I'm not surprised in the direction. It's been our call for some time that the curve would steepen, and so we've seen a steepening. It's mostly driven on the real side of the curve. It's not really so much about people worried about inflation. And obviously, we've had some pretty good growth numbers, too, both the employment data and then the revision to the GDP data. Now, getting it down to the basis point is tricky, but the direction of travel, I think, makes sense.
Do you think it's going to continue?
Well, I mean, I think it will be data dependent to some extent. And obviously we'll hear from the Fed in a couple of weeks. And obviously people are positioning for various election outcomes. So I'll reserve judgment on that till we have a little bit more information.
All right. Well, what about judgment on how many cuts we're going to get for the remainder of this year?
Our baseline is still that we get another 50 basis points, 25 at each of the next two meetings. Coming out of that September Fed meeting, markets sort of were getting ahead of the story a bit and pricing in more than that. I think the recent data and Fed speak has brought market pricing pretty much into alignment with what I think they will do. They're going to take it meeting by meeting. But Scott, I don't think they would have moved 50 in September if they thought that's all they needed to do. So I think a couple more cuts this year would still be the baseline.
Well, let me ask you this. Why should they cut twice? Especially if they're coming to the realization, which I think is true,
question,
that the neutral rate is higher than they once thought it was, and that they're not as restrictive as they thought they were either. We cite Atlanta Fed GDP at 3.4.
Yeah.
I don't know whether that pans out to that number or not, but it doesn't matter. The point is that the economy's stronger than they probably thought it would be. The neutral...
Hold your horses for just a moment. Hold your horses for just a moment. What did we just go over here? Starbucks business model is a complete disaster. Their North American business looks bad, right? Enphase business is in a horrible place right now, right? So, I mean, you look at just two data points we got right there, it doesn't look good. It doesn't look good. Usually, Starbucks usually has good numbers, right? Enphase many times has good numbers, but they have not had very good numbers recently. So if you look at those two data points, you say the economy is actually not very good.
Rate is undoubtedly higher than they thought it would be. Why should they cut twice?
Scott, I think they've made they have the judgment. I think the minutes confirmed this. And indeed, the chair referred to the initial 50 basis points as a recalibration. I think you are correct. There's a range of views on the committee about neutral. And neutral could be higher than most people on the Fed think. But I think they all agree that wherever it is, it's below the current setting of the funds rate. So I think there will be agreement for a pretty broad range of data for another two cuts. But I do think as we go into next year, I do think they'll be generally data dependent. And whether or not we get the cuts that the dots indicated will really depend upon what happens in 2025.
Well, what's your own view, though, on this neutral question and what it means for policy? Because it's potentially significant, right? They may feel like they have the luxury of not cutting twice, and they would explain it by, look, the economy is strong enough that we don't need to. Obviously, we don't want to reaccelerate inflation in a way that would be punitive to the economy.
Sure. So my own view on neutral is, that the front end of the curve, which is what the Fed sets, the funds rate, I'm more or less in alignment that ultimately once inflation gets to 2, that a neutral rate of around 3% makes sense. Where I do think the world will be different than it was before the pandemic is I think we'll have a steeper yield curve. So I think part of the way that the bond market clears is not so much with a higher front-end neutral rate, but potentially a steeper yield curve on top of that.
Yeah, there's a few dangerous things here. You can't just look at like Meta and NVIDIA earnings and say, oh, everything's great as far as the economy goes because Meta's and NVIDIA earnings are going to be great. No, those are very special companies. Those are like the 1% of the 1% top companies, right? You're going to start to look beneath that, and you're going to find just a lot of weakness from a lot of really top tier companies, even the top 1% type companies. A lot of weakness from those companies, right? And remember, the Fed's trying to, they should be, in theory, skating to where the puck is going, right? That's what they should be doing. And so you got to understand, like, if they cut rates here, it's not going to really be seen in terms of helping for quite a while. You're looking at potentially up to 2 to 3 years before it really starts to matter in any significant way. There's a lag there, right? So that's something that, I think should be front of mind there. The bottom line is, do you feel like things are getting maybe weaker or stronger. I think the moral of the story was in 2024, I think it would be overall, if you had to say a feeling, it probably felt weaker, right? Just looking at a lot of company earnings. And you see it from company after company after company, right? Could they reverse a little bit in 2025? Yeah, it's potential. And I think that will be kind of like, well, inflation not biting as hard. But that might be like a minimal help there. So that's something to kind of keep in mind, right? So the bottom line is the Fed does have to keep cutting here. They probably don't have to go insane with the cuts right now. They can probably stick to 25s and 25s for a while. But the moral of the story is they do have to keep on the cutting cycle. Meta's revenue has room to run.
Meta among the names reporting next week. My next guest covers all three, but is singling Meta out today. He's reiterating his buy on the stock and raising his price target to $6.75. This on the company's ability to generate double-digit revenue growth despite all of their AI spending. And the stock is up 60% this year. Brent Thill is here now. He's an analyst at Jefferies. And Brent, Meta's been one of the great stories. You think its run continues? This is akin to what we were saying about other outperformers lately, like gold, like Bitcoin.
Yeah, Meta is in a great spot. They continue to take market share. They're in the right position with AI. Zuck has been lifting weights and wearing cool T-shirts with the necklaces and kind of staying out of the way. And I think advertisers have appreciated his workout routine, which is helping the overall business. And we continue to think they can sustain mid-teen growth. You're on a pathway to get to $30 of earnings power. If you look at other leaders in AI, Microsoft, NVIDIA, others, they're all trading at 30 times earnings. If you get to $30 of earnings power in a year or two and you merely put a mid-20 multiple on it, you're going to get a much higher stock. So we think...
Boom, boom, boom. Let me pull you something up here. Alrighty, so on 1000xstocks.com here, I want to go to compare right here to this particular tab. And I want to show you, I want to pull up Meta. We're going to pull up Meta here. And I'm going to pull right next to it Apple. Okay, we'll pull Apple up. And then we'll pull up, let's pull up Mr. Softy too, Microsoft. Okay, and I want you to see something here. So if we look at forward P of Meta, 26, right? And Meta does usually destroy their earnings estimates, so that could be lower, actually. Apple's at 32, Microsoft's at 31. And that's fine if you were of the assumption that Apple and Microsoft are going to far outgrow the earnings per share of Meta, right? But that's just not the reality. Current year expected earnings per share growth at 43% for Meta versus 7.5% for Apple and 12.3% for Meta. Trailing 12-month earnings per share is 134% for Meta versus 10% for Apple and about 22% for Mr. Softy. Next year, earnings per share growth over 11% for Meta versus 8% for Apple and around 17% for Microsoft, right? So overall, and as far as revenue growth goes for Meta, around the same as Microsoft, right? So the moral of the story here is Meta is significantly undervalued versus these two other peer companies being Apple and Microsoft here. And I look at Meta as having tremendous amount of upside. And like this gentleman points out, it's significantly undervalued. It's significantly undervalued, and you're going to get likely big. I've always imagined Meta being 700 plus before the end of this year. I think they could get there.
Again, the risk is the stock's had a big run. Many things I'm talking about are known. They've had a great trajectory. Do they have to raise CapEx higher than the street has it? We think there's a risk. Do some of the advertising data points start to soften a bit as we get outside the election cycle? There's a handful of concerns that we have, but we do believe, again, in this durable $25 to $30 of earnings power. And when you think about, you don't have to put a big multiple on it to get a higher price, even while the stock has had a big run.
Can we turn to Microsoft? You also, which I believe,
if you just slapped a similar PE on it, forward P that Apple or Microsoft has, I mean, right there, you're already over 700 right there.
Cover. I mean, that one has been underperforming, even the S&P this year, as more people are wondering just how impactful Copilot will be. Incredible to watch it go from first out of the gate, showered with positivity and praise for everything it was doing with OpenAI and on the AI front. Now seems to be playing a bit of catch up.
Yeah, I think everyone was overweight Microsoft, Kelly, and they're basically just selling the stock. They're going into other names. They're going to energy. They're going outside tech. They're going to financials. They're going all other places. And so I think Microsoft.
Yeah, the main thing with Mr. Softy is just like the valuation is not super compelling here, right? Trailing 12-month P of 35, 36, forward P around 32. I wouldn't call it overvalued, but it also is not just at a level of like making people excited, like, oh man, Microsoft's such a great deal, I gotta go buy that stock.
It's had great fundamentals. It's one of the best management teams. It's one of the best CFOs that we work with, Amy Hood. You effectively right now are just seeing a broadening trade. There is no AI in software yet. We've talked about this. It's better to be a semi and hardware analyst. Those stocks are up 50 to 150%. Software's up low teens, and it's underperformed everything. And it's because there is no AI in software today. There is no material monetizable revenue in a big way. Now, Microsoft's monetizing it better than anyone, but it's still a low single-digit % of their total revenue.
I mean, you're striking an upbeat tone to say that it's not in there yet, whereas some say it's, killing the whole sector, and you're more arguing that, its transformation has yet to begin and could pay off.
Yeah.
Just to get inside baseball for a second on the Salesforce piece, which Jeff Smith was talking positively about this morning, given the changes there the past couple of years. Benioff was also criticizing Microsoft. We talked about this on the show yesterday, the way it's trying to now talk about agents as a way of delivering or boosting the impact that its AI Copilot can have. And Benioff's dismissive of that, which implies that, Salesforce now sees itself in a bit more of a better position than it might have been a few months ago. Do you agree with that?
This is nonsense. I'm a huge fan of Mark, but that's nonsense. Microsoft's revenue is so much higher in AI than Salesforce. I mean, Salesforce is in a good spot with Agentforce. We're a huge fan, but that's marketing, and Mark's really good at marketing. So we think Microsoft, again, is the furthest out. They started this revolution. They partnered with the best company, OpenAI. They've had the most revenue impact. While it's still tiny, they are in an incredible position. So it doesn't matter if you rename it Copilot, Agent, whatever. It doesn't matter. There's a bigger, meaningful chunk of revenue at Microsoft than at Salesforce at this point. Okay, so that's just the facts. So Mark's good at marketing. That tweet is or X link is I think is
like I always say, Benioff, he's the best salesman in the world. Certainly
post on X or whatever we call it. So Brent, heading into the thick of earnings season and with some of what the comments you've just made about software and the rest of it, are there other areas of opportunity investors can get ahead of now, places that we might see, upside beats, or even over the longer term, 6 to 12 months time? Are there a few of these names that have been left behind that you think are going to catch up?
Yeah, I think software is going to play catch up. Again, all the software companies are buying the AI infrastructure, so this has to work. And if we get this AI rolled out in 25, 26, software will play catch up. So I think software as a category, the IGV is the index. You buy the IGV. We think other companies like Snowflake, who's one of the worst performers year to date, that can be a catch up trade for 25.
Snowflake stocks. Talk about a stock that sucks. Snowflake. So let's go ahead and check out the snow, baby. Snow. Just check it out here. Need to get rid of all these other stocks I have on here. Holy smokes, I have like a million stocks comparing here. So Snowflake, what are we at? Snowflake 115 that stock's at. So now down 22% on a 1 year with that stock. Lowest it got down to was around 108 there, 108, 109. So, but yeah, man, whoa, brutal fall for this one, right? I mean, you look at it back in February. So February, how many months ago was that? Was that like 8 months ago now? 236, it's basically been cut in half. Jeez. Cut in half in 8 months? Oh, is that brutal? Oh my gosh. Yeah, Snowflake. Well, I mean, Snowflake, could I buy it eventually? It's a stock I could potentially end up buying at some point in time, but yeah, still not interested in that one. Let's check out Snowflake's valuation here. I just want to zero in on Snow. So check out Snowflake. Jeez. 152 forward P, 2 year out forward P, 116. Current year expected revenue growth 29%, expected to decelerate to 22% next year. Analysts have here. Let me go to, I want to go to the charts feature here on snow and see what's going on here. So take a look. The trailing 12-month revenue, certainly a very nice uptrend here for the company in terms of that. Gross margins looking pretty good, but not great. I mean, Snowflake, I would think, would be well over 70% margins, if not closer to 80%, right? I mean, Palantir is an 80% plus gross margin company. If we look at a trailing 12-month EPS, I mean, it's been ugly, right? Very, very ugly in regards to their earnings per share. They are expected to turn that around here, so that's good news for them. But, yeah, it's been a big money loser over time. Now, this is exciting for the company. Free cash flow on a trailing 12-month basis has been booming, so that's good. And then if we take a peek here at operating cash flow, that's been coming up very strong. Shareholder equity has been downtrending for Snowflake, so not great news as far as that goes. So if there's one thing to be excited about in regards to Snowflake, it's that they're flipping to profitability, and it's that their cash flows, free cash flow and operating cash flow, have been increasing immensely. I don't know if that will continue like that as far as free cash flow, because they might have to spend heavy on AI chips. I don't know. But that is a potential. And if they do, that could potentially hurt their free cash flow a little bit. But it looks like their operating cash flow is definitely in a nice trend here. So, yeah, the moral of the story is Snow might get interesting here. It's just not quite there yet. But it might, never know. What happens if the stock goes under 100 next year? Maybe I make a move there.
CEOs come in and put new infrastructure and routes to market and development in. That could be a catch-up trade for 25. We think the hyperscalers are still the best ways to play this. Microsoft, Amazon, and Google. Microsoft and Amazon particularly. So our AI trade for enterprises, Microsoft and Amazon. For consumer, we really like Meta. And
it's crazy. People were just willing to pay anything for Snowflake shares a couple years ago. Like anything. Like, give me Snowflake.
Those are kind of the four big names are going to benefit the most.
And obviously those are more consensus, but I'm very curious to see if you're right about Snowflake and the IGV and software participating more broadly.
Okay, next one up here. He was a big, huge bear, Mike Wilson. I can't wait for this one.
To say it's just been tech, because the reality is that if you look at the technology sector in an equal weight basis, or just look at the average technology stock, it's actually underperformed the S&P 500. What's really worked in the last...
Holy smokers! This guy's got more dang Morgan Stanley branding than I have 1000X branding. You gotta be kidding me. I thought I was winning the branding war on 1000xstocks.com. I guess not. I'm losing a freaking Morgan Stanley over here.
2 years, and really the last 10 years, is high quality large cap stocks that can operate in the environment that we're...
I'm glad they let me know he works for Morgan Stanley, because really I was confused. I didn't really know.
And given and the environment, we've described this very clearly, which is we're in a situation where you're in a fiscal dominance, where the government is just getting bigger and bigger every year. And in doing so, they're essentially crowding out a good chunk of the private economy. And so who benefits in the world that we live in? Large cap companies with scale who can operate in this environment. And that's what's working. So it's not just tech companies. I mean, it's consumer discretionary companies, it's healthcare companies, it's even some energy companies. Okay. Like if you have scale and you're operating well, that's what's driving the index higher. That's what has been driving the index higher. That's starting to change a little bit here recently.
That's just a bunch of baloney. I mean, it's just a bunch of baloney that was, equating two different things that don't even have anything to do with each other. The moral of the story is, like, the past 2 years, the top of the market has been doing tremendous because their earnings per share have been tearing it up. Look at the past 2 years for NVIDIA's earnings per share. Look at Meta's earnings per share the last 2 years. Look at Google's earnings per share. Look at Amazon. Like, go through the whole list of those top tier companies, and their earnings per share has been skyrocketing. And what happens when the most important stocks in the market, when their earnings per share is skyrocketing, right? Many of them up triple digits on a 2-year stack basis. Guess what's going to happen? The market's going to go a lot dang higher. So, that whole little speech there, that was just baloney.
7 underperforming since July, and there's a bit of a broadening out going on. But the broadening out is still happening at the sort of quality level, meaning the market still doesn't really want to go down the quality curve or to companies that have bad balance sheets, et cetera. They're just going into different high quality stocks across the complex.
Mike, we're kind of just starting to get into the teeth of this earnings season. We've had some really good numbers coming out of global Wall Street so far. What do you think the market needs to see out of corporate America over the next couple of weeks in terms of earnings?
Well, you're right. I mean, like as usual, companies have managed the numbers lower going into the quarter. That's not unusual. This quarter was a little bit more negative in terms of the revision. So the bar has been lowered. They're going to jump over the bar. And with the market, like what investors what they're going to buy are companies that not only beat the lower bar, but then give you some confidence that there's actually some acceleration coming. The thing that's been missing in the last 3 or 4 quarters is we don't have any broad acceleration in order growth or, where's the exogenous positive growth shock going to come that's going to rise, lift all rising boats. And so that's why it's become very idiosyncratic, right? That there's a lot of winners and there's a lot of losers right now. And there's share gains going on. And those are the things that investors are keying off of. Who's operating well in this environment? And I think that's going to continue to be the game that's played.
I look at Mike Wilson like NVIDIA. You got Joseph Moore, covering. I know you guys aren't on speaking terms, but when you listen to a guy like Joseph Moore on NVIDIA at your Morgan Stanley, how far out is your terminal value on Mag 7 and on the rocket stock NVIDIA? Do you have to justify its existence by going out not 3 years, but 7, or dare I say a decade?
Actually, Joe and I had dinner last night with some clients, so we are speaking.
Okay, well, tell us about the dinner. No, stop. This is too much. Tell us about the dinner, Mike Wilson. Give us some insight.
It was very enjoyable. It was a very enjoyable dinner with about 20 clients. It's excellent food and great conversation. But Joe, Joe has had the right view. He's been very bullish on the AI winners.
See, that's what Wall Street's all about right there, baby. The nice dinners with the clients, and that's the life, man.
He hasn't been very bullish on the broader semiconductor complex, right? And this is a perfect microcosm of what we were just talking about. Even within semiconductors, okay, you have the big winners, which everybody knows, and then you have a bunch of companies that really just aren't seeing any acceleration in their business because the global economy is kind of and that's what we got. And so in the case of NVIDIA, Joe said a great call. He's not looking 7 years out because it's silly to try and predict that, but he is looking out probably several years. We talked about that last night, which is there's a lot of visibility for 25, and then 26 is when the visibility starts to come down.
I agree.
So the stock will start to discount that at some point. Right now, the momentum is quite good.
Mike Wilson, I got to ask this question.
My 150 to 200 prediction before year end is looking really good, is it not? And remember, I had that call on since the beginning of this year. So I don't think anybody, no, I know for a fact, because I pay attention to all these Wall Streeters, no one had that call on. And I'm looking pretty dang good.
We're going to come back with Mr. Wilson if he deems to. Solid. Mike Wilson, when you heard that James Gorman was going to Disney, were you like the football player leaving the field, we're going to Disneyland? What were your thoughts when your fearless leader who changed your company announced he's going to wander over and help Mr. Iger at Disney?
Well, that was a while ago. He's now the chairman of the board. It doesn't surprise me at all. James is really, really good at this. Managing companies. He did a great job here. I wish him the best, and I think it's exciting for him. So it's the next great chapter for him.
Yeah, Disney's making a bunch of moves, which they need to, because that company's been a mess as well. Another one I just want no base of, okay? Appreciate you guys. Thanks so much for joining me as always. If you want access to my premium courses, access to my Discord chat, you want to apply to join in there, click the pin comment down there, fill in an application. We'll see if we can get you access maybe next week. Much love and have a great day.